There's a reason why the market crash of 2007 and 2008 is referred to as the global financial crisis. Even though it started in the housing market, it's when it spread to financial institutions that it started to affect everybody. And then the bond market, the stock market, the housing market, everything went down in unison. People lost their jobs all over the world because the banks are the one common denominator that everything touches. And this is the real threat that's lurking behind the scenes right now with the collapse of the Chinese housing market. Is what effect will this have on China's banks, and will it spread to the rest of the world? This is part 2 of my interview with the last bear standing. Bear is one of the first people to sniff out this problem in China, and he's been saying all along, watch those Chinese banks. That's where the problem is going to spread. All along, since as far as I've been following you back, since October, you've been saying it's not about the developers, it's not about Evergrande, it's the banks. You've got to watch the banks. And in one of your more recent articles, when you were talking about this finally spreading to the banking system, you made a distinction between liquid and solvent, and how that's really what you need to watch, and how we really don't know. The curtain hasn't been pulled back yet, and we don't know just how insolvent or how many of these banks are really insolvent because they've managed to stay liquid. Could you fill in a little bit there, and what that means and what we're starting to see with some of these rural banks that are starting to go belly up now?
Yeah. So exactly. The thesis that I kind of laid out last year, sort of late last year, started obviously with the developers, which are a big part, sort of how this whole thing got kicked off in terms of the crisis that's precipitating now. But the question of, okay, what happens when Evergrande, who has $300 billion of liabilities, goes bust? The logical next question is, okay, so who are those liabilities owed to? The phrase of, if you owe the bank $100, versus if you owe the bank $1 billion, that sort of concept where a lot of obviously these developers have had funding from overseas. The US dollar bond market has been a huge source of financing over the past several years, but a majority of the liabilities, which are just astonishingly large, are sort of internally held within China in the banking sector and the shadow banking sector, which includes things like trusts and wealth management products and basically different investment products that individuals and I guess largely individuals can invest in. But the banking sector in China, I think it's tough to get specific numbers, but probably the real estate exposure or the banking sector's exposure to real estate rather is something like in between 30 and 40% of their total loan book. And if you think about the fact that real estate plays such a central role, not just in the direct exposure, but also the indirect exposure of contractors and all the different sort of supply chains and everything else that goes with it, you have to think that the real exposure to this, to real estate by banks is, something, maybe north of 50% if you were to consider all sort of the tangential exposure and the role that real estate plays in the economy. And now you have a situation where, the entire industry, if you look at developers, I mean, there's not a single developer that is that is not under extraordinary liquidity stress and effectively insolvent at this point. And you're talking about trillions of dollars in liabilities. Now you have to also look at, home buyers' mortgages that people are stopping to pay. And so it's almost, if you think, even if you thought that the Chinese banking sector was in great position, in a super strong position in 2020, any banking sector that had a exposure of 40, 50% into a single industry that has collapsed in the way that it has, like the real estate bubble, you would be very, very concerned about the viability of those banks. And we know that it's not the case that those banks were in a good position into 2020. And you can see that by things like Huarong, which we already talked about earlier. But basically the practice of basically never dealing with bad debts and just sort of leaving them on books at face value or moving them off the books in creative accounting ways. But basically you've had, it's pretty clear that the banking system was already sort of overburdened with bad debts that really haven't been recognized. And so when you take the combination of the total collapse in real estate, the exposure that the banks have to real estate, and the fact that they were coming into this whole situation already bearing a ton of bad debt from the past decade, it just seems obvious that this is, that certain banks will fail. And so what's happening, I guess, to your point about solvency versus liquidity, the point that I was making there is that solvency, if you think about a bank's solvency, that's really looking at their whole loan book and seeing whether, seeing what the actual value of those loans are. So the bank could hold a loan on its book for $100, and it's really up to the bank to say, what is that loan actually worth until they get paid back. And so the bank could recognize losses appropriately and say at every given time, at every given quarter or whatever, provide a realistic update on the actual sort of recoverability of that loan, or they could leave it on their books for $100 and say that everything is fine, even though they won't actually get the money, when the debt comes due. So what you have in this situation with these banks is they basically kept all these loans that were, like real estate loans, but also other loans to corporations and whatnot, that haven't been recognized yet. And so on their books, it shows that they have, 10% or sort of normal equity balances. It doesn't show that they are stressed from, a regulatory perspective. But that's because they haven't sort of recognized the true recoverability of these loans. And it's really hard to force from an outside perspective to say, hey, your loans are bad on your books, because we don't really know, the details of those loans. We can look at it sort of a top-down perspective and say it's likely that many of these loans are bad, but we can't really look with specifics and say, you should be taking a 15% haircut here and there. And so it's really tough to sort of call out solvency. But we know, I think it's logical to conclude that many of these banks are insolvent. But so the rubber sort of meets the road when it comes to liquidity. So you can't fake being liquid, right? Like if you don't have money, you don't have money. And that's when things, sort of break down, and it forces the acknowledgement of, the fact that the actual situation financially for these banks. So for example, if a bank was expecting to receive $1 million from developers repaying their loans and mortgage buyers repaying their loans in the coming month, and they don't receive that money because the developer's broke and because mortgage buyers aren't paying their loans, that puts liquidity stress on those banks. And they can't fake the fact that they aren't receiving that money. And that is how ultimately, I think it's likely that you will see the failures is when those liquidity stresses force the issue and sort of make obvious the fact that many of these banks are insolvent.
And is that what we just saw in Henan province with those small village banks that failed? Is that the signs of liquidity there?
So I think in that specific instance, there was it's somewhat related to real estate because everything's related to real estate. In the instance of the most sort of talked about bank, I think that much of those issues were really more sort of a graft situation where basically a lot of the money from this bank had just kind of gone off to specific individuals who had kind of absconded with it. And it wasn't necessarily a situation of a bunch of loans souring, but regardless of the sort of reason why, what was the root cause, I think it's basically the same principle where all of a sudden the bank basically said to people, hey, you can't withdraw your money. And then all of a sudden people, because they didn't have money, because in this case, somebody absconded with it or whatever. But what happened, how that was brought to light was not because the bank came out and said in their, annual filing, hey, we lost a bunch of money in the past 5 years, 10 years. It's when they ran out of money and couldn't, didn't have the funds available for their, depositors to withdraw money. And that's when it sort of forces the issue and these things come to light. So while that instance wasn't a perfect example of sort of these, the stress of the real estate market, I think it does show how this could likely play out when you have banks come under liquidity strains.
Now, you've also mentioned in some of your earlier Twitter threads and in your Substacks that interbank lending was going to be the trigger, or it'll be the tell this time around. That's what happened in the repo market in 2008. That led to the global financial crisis when the banks go on defense and they stop
Yeah.
lending to each other, and then whoever is in trouble at that given moment, they fail. Is Are you seeing any signs of this?
So I think it's tough to tell because there's just it's a much more opaque market than the U.S. It's also, I think, not just to us as outsiders, but I think internally there as well. But the issue that we have with the interbank market in China is that the PBOC, the Central Bank of China, can inject money, and they have been injecting money into the banking sector for the past 6 months or so. But those injections only go to the largest banks. I forget the exact number off the top of my head, but there's something like, I don't know, 3,000 different banks in China. The largest ones, which are the big state-owned banks and some of the large national privately owned banks, are the ones who receive, who have access to that PBOC liquidity, and they need to basically spread that money down through the banking channels from the large central banks through the mid-sized banks down to the rural banks. And so there's a transmission that needs to happen that's sort of away from the central bank's control, as well as some of the more market indicators of interbank stress. So you can look at things like SHIBOR, which is basically LIBOR, Shanghai LIBOR, but is an interbank offer rate. And because of the liquidity injections over the past 6 months, you don't see any stress in those markets if you look at those rates. But I think and that's led certain people to believe that the system is sort of awash with liquidity. And in some ways it is, because the PBOC has injected a lot of liquidity into the system. But if it doesn't go to where it needs to go, then that doesn't prevent failures from happening. And I think that the benchmark rates are really reflective, or not necessarily reflective of the entire system. And so to your point about sort of the freezing up of markets, I think it's when banks start to get concerned about each other that things get very hairy. So when banks who are ultimately responsible for the transmission of that central bank liquidity out into the entire banking system, when they start to fear for the viability of these banks, that's when they will stop lending, and those transmission chains will break down. And that's when you have sort of the sort of cascading liquidity crisis.
Now, I get a lot of questions on my channel about contagion. People always want to know, where is this going to affect? Is this going to affect me in Europe? Is this going to affect the States? I realize a bubble this big and this interconnected, it's hard to say, but give me your best guess. What is going to be the first knock-on effect outside of mainland China of this collapse?
So I think if you were to see sort of a financial crisis, some sort of banking crisis, I think that could be a sort of an event that causes a shock in other financial markets, even if it doesn't have direct linkages. I'm sure that there are direct linkages, but just from a sentiment perspective and sort of a risk-off perspective, I think that you could see transmission just through those channels into other markets like the U.S. In terms of direct exposure, because most of the lending is sort of domestic. The good thing about that from outside observers is there is not necessarily a ton of direct exposure to loans and whatnot outside of the country, especially in the U.S. So it's not really. I don't really have any concerns about U.S. domestic banks having some sort of exposure to the property sector directly. But I think that you could see it through contagion in financial markets. I also think that just from an economic, sort of more of a fundamental economic perspective, if you think about the total amount of if you look at commodities, that's the one place where it stands out as being as sort of taking this on the chin. If you think about the amount of steel and cement, and rebar, and everything else that has gone into these, this construction in China for infrastructure and for housing for the past 10 years, it has been the driver of global commodities. Which obviously we've already seen that sort of reverse. If that demand totally dries up, which it mostly has, that's going to reverberate through commodity markets in a notable way. But I think one of the I've definitely gotten the question a lot, like why do I care if I'm a U.S. investor or if I'm a European investor? And I think it's tough I don't really have a good answer for it. I think that what I've written about the developers and Chinese banks are things that I can sort of tie direct lines from one thing to another, where I can be highly confident about this causing this. I think once it gets to how does this impact the global economy, it's a lot harder to say because it just gets increasingly complicated and sort of the lines become less and less direct. And so it's just something that I think nobody will know until it plays out.
So, as Bear points out, folks, it's really hard to see what might happen next in China and where it might spread. Number one, because the Chinese banking system is so opaque. Simply put, they just don't tell the truth. Some cases, they just don't release audited financial statements at all, or they leave defunct loans on their books at face value, even though they have no hope of ever getting that money back. They still hold it as an asset at the same amount that they lent it out for. This makes it nearly impossible to understand just how big this problem is when you look at the data coming from China's banks. For all we know, this thing could blow up tomorrow, and we'll never see it coming because they just don't tell the truth. And as Bear mentioned, it's really anybody's guess where the contagion goes from there. Folks, this is just part 2 of my 3-part series with The Last Bear Standing. I've got links down in the description below to part 1. I've also got links down there to Last Bear Standing on Twitter and his Substack. I highly recommend both of those. As I mentioned, he is one of the first people to sniff out this problem in China, and he's been talking about it for months. He was way ahead of the rest of the pack on this, so I highly recommend both of those. And until next time, live small and dream big.